Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Let's talk about the bond market. Lisa's favourite, the 10-year government bond yield is lower on this week for a seventh consecutive week, the longest streak in more than 5 years. Steve Major of HSBC, good friend of this programme, good friend of ours, joined us here in New York. Steve, it's good to see you.
Good morning.
What's behind that rally of almost 2 months on 10-year government bond yields?
I think you touched on some of it in the preamble. Can I call it a preamble?
You can call it the preamble, the setup, the appetizer, for this, the main course.
The BS session.
As you teed it up, yeah. So how do you disaggregate this bond rally? Because it probably started with something really simple. It could be the market was just too cheap. So there's a valuation angle, and you can see it in swap spreads, you can see it in US bond yields versus the rest of the world, you can see it in real yields being above 2, all that kind of thing. So maybe point 1, it was just too cheap. And then you get some trigger events, or you get something that starts to spark it. And I think maybe there was a bit more confidence in the fiscal position. And so I think you mentioned Doge, that could be key. In between the date of the election back in November and the inauguration, I think markets were also sensing the regulatory shift, which meant there could have been some pre-positioning which was more favourable towards treasuries. Now, that was coming in the treasuries versus swaps spread, right? So there's a bunch of things that were happening. You talked about 7 weeks of bond rally. I think it's been helped by some of the forward-looking data. So Atlanta Fed, GDP now, some of the survey data. Think about what's going to happen to confidence when uncertainty goes up. So uncertainty is not volatility. Uncertainty in the real world, in the real economy, means people sit on their hands and they don't do stuff. It means that investments aren't made, decisions aren't made, and that's not good for growth. Uncertainty in markets normally means there's a big dispersion in opinion about what's going to happen. But I think in the real world, it's actually consistent with the surveys softening ahead of the real data.
It's completely against the grain compared to where we were at the end of last year, and that's what's intriguing for us on this programme. At the end of last year, when Donald Trump won the presidency, we saw curves steepen and yields push higher at the long end of the curve. And people were talking about things like tax cuts, more issuance, heavier supply still to come. Have we just parked that story? Can we ignore that story?
Again, positioning is important. We came into the year with the consensus position, and the position being a bearish steepening of the curve, inflation, fiscal, blah, blah, blah. I did an interview with Manus at the start of the year, and I said, I'm not meeting any bomb balls. That's because there weren't any. Right? So once you get a bit of momentum, then people become a bit more confident. And it's a bit scary, the recency bias in these markets, in that people do like a bit of momentum. And so I think the first move was positioning and the consensus, and then some trigger points. And now for this rally to be continued, for it to be sustained, you're going to have to get something in the data. You mentioned payrolls, but it's really economy data. So the economy is kind of being retrofitted to where the Fed already took rates. Does that make sense? Right. The idea that maybe they cut too much, at the time, nobody was really saying it, but at the time, it seems that they were cutting into a window where there was an opportunity to cut. And then, of course, bond yields went up a lot, even though policy rates had come down 100 basis points. So something was wrong. So the bond market is moving back into line, but really the economy has to be fitted to where the policy rates are as well. So there's a lot of this going on that I think explains the bond rally move. And we can get through 4% on the 10s in the next few weeks with this momentum continuing. If we're talking about 10 weeks of bond rally in 3 weeks' time, we'll be through 4.
Okay, so basically what I'm hearing from you is that if we get some weaker economic data, we could see this bond rally accelerate. We get the 10-year below 4%, and the idea of real growth concerns bleeding through the entire Treasury space.
Yeah.
How much do you buy the idea that this bond market and this Federal Reserve is going to be constrained by stagflationary fears, stagflation light, et cetera. How much does policy play into this?
You're quite right, Lisa, to qualify it with stagflation light, because you know that pure stagflation requires recession and accelerating inflation. We're nowhere near either of those at the moment, so you're quite right to qualify that. It strikes me that inflation between 2 and 3 is not a problem for anyone, and it's probably part of what's really desired, because there's too much debt, and the process of dissolving the debt requires inflation to be a touch over target. I don't think anyone's going to worry about 2 to 3 on inflation. The Fed's already pivoted to a growth focus. They did that last year. And now we're seeing validation of that pivot. So as I said, the economy needs to fit to where the path of lower rates needs it to be. That may sound like a reverse in the causality, but this sometimes is how it works, right? So I'm not that worried about inflation, and your famous last words. But
well, I think that you're not that worried about inflation, but Fed officials are, and they're talking about the potential for having to choose, having to weigh the two evils of whether inflation is sticky or even accelerating modestly, and some sort of downside to growth.
Yeah.
As bond investors, how do you grapple with it?
It's fair what you said. It is part of their job. And there are some in the Fed who don't completely worry about inflation so much, right? So that you have a range of views, just like in any central bank. The fiscal policy, I think, is dominant. You've heard of fiscal dominance. For the bond yield to be at the right level for the fiscal policy, it needs to be at 4% or below. The CBO, the budget office, is budgeting 4.10 on the 10-year. Now, back in September, we were at 3.6 almost, so it was nicely inside. So to be able to afford this level of debt with the interest payments that come from it, we need the yields below 4. So I think that by having a fiscally responsible treasury set up and the expense cuts coming through and the economy cooling, you haven't got to worry about inflation so much, Lisa. I think it is their job to be a bit hawkish on inflation, but I don't really think it's a problem.
I'll ask a simple question, which requires a very thoughtful answer, and I know you've given it some thought. Does the supply matter?
No. Next question.
Why not?
Right. So I have this conversation every day of the week with clients, right? And you think about from a trader's perspective, it does matter because they've got to take down all this supply and auctions and syndications, and so there's a concession around the supply. That should not be confused. That concession around the supply should not be confused with a strategic view, because the bond yield is a function of today's policy rate and expectations for that policy rate where it ends up in the future, right? And it strikes me that it could be a double counting on the yields if we start adding too much additional term premium to what's already in the price. So if the Federal Reserve thinks that the deficit's a problem and is causing inflation, then they're not going to cut rates. They might even be hiking them, right? But if the Federal Reserve thinks this economy is cooling down and the stock of the debt and the interest payments are weighing on future growth, and in fact there's a path to lower rates in the second half of the year, they are cutting into along that path, right? So it just strikes me that it's very dangerous to say, oh, there's a lot of supply, the yield goes up, because there's no empirical evidence for that. Look what's going on in China and Japan, and also look at the bond yield, which is above 4%. It's around 4.25. The policy rate is 4.25, 4.50, right? It doesn't strike me that there's a lot wrong with a bond yield that reflects the view that the policy rate is going to stay unchanged for quite a long time. If you change that view to the fact that the Fed is back on the path of lower rates, the bond yield should come down, right? So, but I don't know, there's this intuition that the supply matters. It's informed by the auctions and the syndications and the concessions that the dealing rooms have to take into account, right? But not to be confused with a strategic view on where bond yields will be.
Steve, I knew that would provoke a bit of response. Eventually. Steve Major of HSBC. Steve, it's good to see you as always.
austerity and more tariffs. That's the message from the White House. When it comes to this deadline on Tuesday, that pause for 25% on Canada and Mexico, unless they showed they were doing enough to stop the flow of migrants and also really fentanyl, then those tariffs go into play. And then the president add really a spanner in the works, adding an additional 10% when it comes to China. So let's break all this down because the calendar is getting very busy on the trade front. Kellyanne Shaw joins me. She's now with Holgo Lovis, but she was a former senior White House trade advisor and negotiator under Trump 1.0. Let's just start with the calendar. March 4th, we have this pause. But the directive's already there. So unless they come out with another executive order, those tariffs on Mexico and Canada, 25% go into place. And then Donald Trump added an additional 10% on China. March 12th, 25% on steel and aluminum. April 1st, we get the whole report of where trade is right now in terms of reciprocity with American partners. And April 2nd, auto tariffs, reciprocal tariffs across the board. What are you focused on?
Can I say all of the above? It has certainly been a busy week from trade. And on top of that, we just got the confirmation of U.S. Trade Representative Jamieson Greer, as well as the announcement after the Donald Trump and Starmer bilateral of a U.S.-UK FTA, which will be negotiated soon. So any one of these would be enough to derail a trade lawyer's week. And so we have all of these happening at once. So what I can say is I think the president is just gearing up. I think the calendar is only going to get even more full, especially as we get closer to that April deadline for all of those reports that are due. And I fully expect him to continue this trade train for the next several months and next couple of years.
How do you read the tea leaves right now when it comes to Canada, Mexico? Let's start there because those are coming into place Tuesday.
Yeah.
We have the Mexican economy official minister here in Washington, D.C. Yesterday met with Jamieson Greer. Today is going to be meeting with Commerce Secretary Howard Lutnick. We have the Canadian fentanyl czar meeting with Tom Homan this week. Do you think these two countries are offering enough concessions for Trump to put out an EO saying the 25% will not go through?
Yeah, I mean, what I'm picking up are somewhat positive signals from both the Canadians and Mexicans in terms of how those conversations are going. However, it is very clear that what the president wants is a reduction in deaths related to fentanyl and cooperation in terms of the border and border security. And so what I think will likely play out over the next couple of days is a high-pressure situation in which the president is asking both Canada and Mexico for more so that they could potentially announce on Tuesday or Monday night some sort of suspension for an additional 30 days or period of time. But you cannot fix these issues overnight. I think it's going to take several months, if not years, to resolve some of these core concerns of the president. So my expectation is that best case scenario from the perspective of Canada and Mexico, we see another suspension that continues to get renewed periodically as these issues continue to be resolved. But I'm hopeful that there is that opportunity.
And then Tuesday night, he'll have his joint address to Congress. So potentially he can go in saying, look at all these concessions I got when it comes to immigration, which I was elected to really clean up. And that's the president's words. When it comes to China, is this additional 10% real?
I think so. I think so, because I don't see scope for the United States and China to resolve the president's core fentanyl concerns between now and Tuesday. I see Canada and Mexico here. I see active negotiations. They have a representative from almost every agency and every province of their respective governments. Those conversations aren't happening between the United States and China. Rather, I think some of those conversations are going to happen after April. That's when we've got the report on the phase one compliance. We have the report on the Biden administration's $18 billion of additional tariffs. And we also have that report on China's IP practices that are all due to the president with recommendations. And that's what I think is going to tee up a broader conversation that also involves fentanyl and some of these other issues with China.
So China responded overnight. And this is what the Commerce Ministry said. If the U.S. insists on having its own way, China will counter with all necessary measures to defend its legitimate rights. And then previously, though, in February, the response is we would take corresponding steps. So counter versus corresponding, what kind of reciprocal action could we see from Beijing?
Yeah, and I think you're seeing an uptick in the rhetoric in response from MOFCOM this time. I mean, 10% to 20%, you're doubling the tariff impact. I do think that both sides have an interest in not driving the relationship off an economic cliff before those talks begin after April 1st. But that said, China's going to have to respond, and we've seen that play out for the first 4 years of the Trump administration. I think we'll see that same pattern play out in these second 4 years, which is that for every action, there's an equal and opposite reaction on the side of China and the United States. So I do think we'll see retaliation. It could be more tariffs. It could be additional entities added to the unreliable entity list. It could be export controls. There could be a number of things that China does. But again, I think it's going to be fairly moderate in terms of their response because there is an opportunity to resolve some of these things in the short term.
You were in the room for phase one, the trade deal that Trump did in Trump 1.0. What do you think he wants this time?
Well, I think it's not as clear. So during the first 4 years, what was clear to us as negotiators is that the president was looking for China to stop stealing U.S. technology, stop engaging in unfair trading practices, and stop subsidizing industries at the impact of U.S. exporters in third country markets. But what was challenging for us is the fact that China has a state-directed economy, and they're not going to back away from that. They're not going to stop doing some of these things that are so impactful for the United States. And so it's not really clear what the president is going to be asking of China this time. Certainly living up to phase one, certainly help and cooperation on fentanyl. But beyond that, it's not clear what the asks are going to be on the administration side. And by the way, on China's side as well. They're interested in the U.S. backing off on export controls, potentially backing off on some of these national security measures. And I'm not sure there's really a runway there for both sides to land the plane.
If you were in the administration now and you were at the table negotiating this, does it help or hurt that there's a barrage of trade headlines every single day?
Well, I think this is just the way it is, right? I mean, President Trump, as you said, ran on immigration, he ran on inflation, he ran on tariffs. And so he's doing what he set out to do. And I think he only has 4 years to do it. And so to the extent he's looking to fundamentally change the global trading system and enact some of these policies he's been talking about for decades, even before he was elected president, all of that has to happen quite quickly. And so that's what I think you're seeing play out. And that's why I think this is going to be a very full plate for the next several months.
When it comes to the April 2nd tariffs, the Wall Street Journal this morning is saying administration officials are privately indicating that the full reciprocal action will take longer than April timeline to implement, up to 6 months or even more. So even if we get the direction of travel April 1st or 2nd, when do you actually think the tariffs, when it comes to the baseline reciprocal tariffs, actually come into play?
Well, I think it depends how they want to structure this legally. The president has a number of statutory authorities which he can use to impose tariffs, and he can do a reciprocal tariff, baseline tariffs, product-specific tariffs, supply chain tariffs, and he's talked about some of these over the past couple of weeks. And so he can do that through these Section 232 investigations like we saw for copper just this week. He can do Section 301 investigations, which is the type that he used for tariffing China during his first term, and these take several months, if not a year, to complete. I think they can do them much faster than the statutory maximum of a year. But that said, it's going to be up to the team as to how they want to structure some of these tariffs. And some of them will be overlapping because they'll involve not just like the entire economy of a country or a universal baseline style tariff, but also very product specific tariffs.
Product-specific, so it's going to be a very long list.
Yeah.
All week we've been talking about Canada, Mexico, the United Kingdom, potentially a trade deal. He's announced yesterday he's going to be there. The European Union. What should we be looking at next? Where do you think he's going to target next?
Well, I think he's starting with North America. It's very clear. We have the largest trading relationships and trade deficits with Mexico and Canada. And I think China is going to be fast on the heels of North America. But he's talked a lot about Europe and his plans for Europe over the past several weeks as well. And so in addition to the major trading partners that he's mentioned, the U.S. Trade Representative issued a request for comments last week in which they specifically identified a number of countries that the administration is concerned about. Those include the G20 economies, as well as countries with whom we have a large trade deficit. So I also have Vietnam on my list, I have South Korea, I have Japan, and I have India on my list as major priorities of the Trump administration throughout this first year.
Kellyanne, thank you so much for joining us this morning. Your insight so useful. Jonathan, Kellyanne Shaw there.
Andrew Hollenhorst of Citi is with us around a table to break down the economic data. Andrew, good morning to you. We'll get to inflation in just a moment. Let's start with personal income versus personal spending. Income up, spending down. What gives?
Yeah, this is really interesting because we've had such strong personal spending that has been the engine of growth and resilience for the U.S. economy. And now in the month of January, we're seeing that weaken. We already knew some of that from the retail sales reading. We're seeing a little bit more of that in what we're seeing in personal spending this morning. I think you have to take that with all the positive data we've had for the last several months, but this could be the start of a slowing trend.
Soft data has been soft. You, Mitch, On the consumer, soft. The Conference Board earlier this week, weak. I want to understand whether that is going to translate into weaker hard data. It's early to say that, yes, we're seeing that right now with conviction and confidence, but is that what you're forecasting?
We think we're going to see at least some slowing in consumer spending. I think you kind of have to, just because we've had the savings rate at such a low level and you can't just continue to run spending above income forever. So it was always going to slow down. I think the question now is it slowing a little bit more sharply? And it is interesting what you mentioned, because you see this across the soft data, the consumer surveys, and then also that services PMI. That was really the big surprise, that number came below 50 coming into contraction. And now we're seeing it in some of the hard data. Now, again, we had really strong consumer spending in December, so I don't think you want to make too much of this weakness in January. Maybe February we're going to go back and just continue expanding again. But if we get a weak reading in February, then that is a trend, and that does line up with what you're seeing in the survey data. So a little more of a hint here that we're slowing down.
Yeah, it goes to this whole preemptive inflation anxiety. Is this the evidence of it right here, that people are stockpiling more cash, they're earning more, and they're spending that much less? You're saying it's too early to call that this time, but going forward, we'll have to see. You've been generally calling for a weakening in the economy even before some of this PIA. I'm curious, what are you looking at right now that gives fuel to that, even amid the otherwise pretty benign outlooks that we're hearing from companies?
I mean, if you think about the things that have supported this economy, and again, it's been a consumer spending story, and it was the fiscal stimulus, it was equity prices that were up 20% year after year, it was house prices that were up much faster than is typical, and none of those things are happening now, right? The fiscal is coming off, you have equity markets that are kind of moving more sideways, house prices are still increasing, but not increasing at those really rapid rates that they were before. So all of those tailwinds to growth are diminishing. So I'm not surprised that we're seeing some slowing. Now, to your point, are we seeing maybe somewhat of a sharper pullback because there's some uncertainty out there? We could be seeing that. I just think it's premature to really say that we know that.
You were calling for many more cuts than other people and talking about the generally weakening economy paired with real disinflation. And this has been something that's come under challenge recently from a policy overlay, that maybe some of the tariffs and the rejiggering of the global trade sphere would end up with a higher level of inflation more permanently and stagflation-like situations. How much do you lean into that? How much do you think that is kind of what we may see?
Yeah, there's no question that there are concerns, and there should be concerns about longer-term structural inflation. If we're going to a more fragmented trading environment, that's just going to be more inflationary for the global economy. But what I'm really looking at right now is the cyclical story. What's the cyclical story that we're seeing in the U.S.? And what we're seeing in those cyclical categories of inflation, things like shelter inflation we were just talking about, that's cooled, and that's probably cooled persistently. So I think that's part of what we're seeing in the market also, is not that necessarily we've reached where we're trying to get to, or the Fed's trying to get to on inflation. It's not that we're at 2% inflation. Clearly we're not. We're a bit above that. But that pathway is there. And if there's less concern about inflation staying elevated, then concerns can shift to some of these growth concerns, and it becomes a little bit less balanced. And so I think we're still very early innings of that, but maybe that's what the market's doing a little bit.
Andrew, a lot of people are blaming the trade headlines. Neil Dutta of Renmac made the case on this program earlier this week that was an ex-post rationalization for a slowdown that's already started. Would you agree with that?
Yeah, I think so. I think maybe in some of the consumer sentiment data, you're seeing some of those trade-related anxieties reflected, so that can affect the soft data. But spending for the month of January, I really doubt that this is being affected by trade uncertainty.
You say it's a cyclical kind of weakening. At the same time, some people think that maybe the momentum is just moving away from services back to goods, and that you might see some of the weakness in services paired with some of the strength that we're seeing in the physical world. Why do you reject that?
I don't necessarily reject that. You do see that to some extent in some of the survey data and some of the diffusion indices, where you see this sub 50 services diffusion index. So maybe we're actually contracting in the services sector, whereas manufacturing diffusion indices have moved above 50 now. So you do see some of that in the data. But what I would say about manufacturing is, number one, it's a smaller share of the U.S. economy than services. Services is going to be the more important driver. And number two, we still have high interest rates. We still have a strong dollar. Those are things that are going to weigh on manufacturing as well.
First rate cut, give us the month.
May.
Why May?
We think in May they'll see enough, Fed officials will have seen enough to conclude that inflation is slowing, that growth is slowing, and resolve some of the uncertainty around tariffs and trade. April 2nd is the date when we're supposed to get some announcements.
Is March 19th a snooze or not?
It is just probably a wait-and-see meeting, yeah. I don't know if I want to say snooze because it's my job to make these things interesting, but I'll be tuning in. I'm not sure a lot of others will.
We'll be here. Andrew Hollenhorst of Citi. I hope others tune in as well. Kushma and Morgan Stanley joins us now for more. Michael, jumping into the seat, into the studio. Good morning, sir.
Good morning.
I mentioned BNP Paribas, who said a few times earlier this month that the Federal Reserve was comfortably numb. How uncomfortable are they going to be in a few weeks' time?
Well, they may be uncomfortable, but they'll have more information about exactly how serious the Trump administration is on imposing these tariffs, because we know that the use of tariffs has multiple objectives. One is to extract other concessions on other issues. Second one is to raise revenue to achieve their budgetary goals. So how those are balanced and the inflationary impact versus the negative economic growth impact, juggling all those things, we're not sure how they're going to weigh those things, and the Fed has to wait to see how they're going to judge those factors.
Got to make some kind of underlying assumptions, though, about how this is going to play out for the year ahead. What's your base case? What's the baseline for you and the team?
The base case is that, in general, macroeconomics was just tariffs are stagflationary. It's like a tax on the economy with like a supply shock, and it's not good, at least in the short term, before longer-term production adjustments can occur. So in some sense, you would think this puts the Fed in an uncomfortable position with stagflation, and outcomes are ambiguous as to what you should do. How big a negative impact will have on the economy in the short term versus how inflationary it will be. And you think about, the Trump administration's policies could be, there's positive things about it, there's negative things about it in terms of supply side, demand side, but the headlines in the short term are quite, with the trend in spending and the economy a little weaker than expected and recently, is putting this a little more downward pressure, which makes, I think, maybe a little more nervous that maybe of the next couple of months that the economy may be softer than expected.
It's difficult to have conviction at a time where, as Goldman Sachs put it, you end up with headline roulette. How can you basically come up with any kind of conviction if you're dealing with potential threats that emerge that are unclear at different moments? Do you have any conviction yet?
Well, the conviction has been that the underlying momentum of the U.S. economy has been strong, but narrowly based. The Biden administration was a lot of government spending, tax policy driven growth in the economy. Employment growth was strong, but inflation was high. We kind of knew what to do with that. The Fed would cut rates if inflation was low, and there was some signs of weakening the economy. But going forward, I think it's much more uncertain as to how the economy is going to play out. So you have to wait and see. So we've adopted a more wait-and-see attitude. We think credit markets are still pretty robust. Corporate fundamentals are really strong. Could they deteriorate at the margin? It's possible. So we're a little leery of adding and taking big bets in credit markets. But on the other hand, there's no signs yet that the weakness we've seen lately. Remember, January and February were really weird months in terms of forest fires in California, really cold weather, how that was disruptive to it, tariffs and Trump policy, how disruptive that was to people's behavior. Headlines are certainly not very conducive to being confident about the future, with layoffs, falling spending, reductions in government spending.
So what would it take for you to get bullish on long-term bonds to actually think that this is going to be a growth impact?
We'll have to see the unemployment rate change. I think the Fed has an employment mandate and it has an inflation mandate. And the inflation situation was not great lately, but this could be better in the next couple months, or it could just go sideways. But the unemployment rate stays where it is. The Fed's going to find it tough to change policy from where we are today. But we have seen big swings in Fed attitudes towards policy in the last 12 months. July and summer of last year, when inflation was going up after the first half of the year, the Fed said maybe no rate cuts rain of the year. By September, lots of rate cuts, and now maybe not so many rate cuts. I think they're very much in the thing, we don't trust our models. We're going to wait and see how actual data evolves, data dependent, but they seem to be very responsive to short-term fluctuations in data, which have been fairly erratic.
We've seen risk markets, risk assets get hit a little bit over the last week or so. Is the Fed put constrained? given the risk that they face, the two-way risk that some people have described?
I think it's constrained from the point of view of responding immediately to weakness in equities. If spending in the U.S. economy, we know, has been led by the high-income part of the distribution, and as we know, wealth effects have been very powerfully positive for high-income people in terms of the equity market, the housing market, crypto markets, whatever you want to call it. It's all been up, up, up. So even if income growth hasn't been great, you feel wealthier, you spend more money on durable goods and holidays and things like that. If that is starting to start to worry about that, and there's a story that the Fed is indirectly targeting the equity market. The economy can't slow, inflation can't slow unless the equity market does worse, because that will slow spending of high-income people.
Does that help or hurt the 10-year?
It helps the 10-year. I mean, there's a story that I've seen around that maybe the Trump administration is not targeting the S&P as a measure of success. It's the 10-year Treasury. Yep. The lower it goes, the better.
So let's just do some scenario analysis. Next year, by the way, I'm turning into TK with my throat clearing, and I apologize.
Sure, Tom appreciates that.
Well, he's in this chair, one thing leads to another. I am curious. Next week, on March 4th, if the tariffs are put on, what happens to the 10-year? Does it rally or does it sell off?
I think it rallies.
Significantly.
I think the markets are more concerned with downside implications for growth than they were about upside inflation surprises.
What shifted from late last year till now?
I think it's the actual data that's been weakening prior to all this tariff stuff, when people were not sure that the administration was serious about imposing tariffs. Well, this is just a negotiating tactic that could go away. But data has actually been weakening into this environment. So the economy is more fragile, not for weak growth, but weaker growth. So you think U.S. growth has been toggling between 2% and 3%. Well, if we fall below 2%, I think the Fed put starts becoming more operative again.
Michael Kushma of Morgan Stanley. Lots to think about, sir. Thank you.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.